Right now, this exact second, while you're watching this video, America's national debt just grew by a few $100,000. It's adding roughly $8 billion a day. Not a typo. $8 billion every single day. The total? It just crossed $39 trillion. That number is so large your brain can't actually process it. So here's a way to try. If you counted $1 per second without sleeping, without stopping, it would take you 1.2 million years to reach 39 trillion. And yet, the US stock market is sitting near record highs. Treasury bonds are still considered the safest investment on earth. The dollar is still the world's reserve currency. That contradiction is the entire story tonight. Because normal logic says, if a person borrows more than they could ever realistically pay back, they go bankrupt. But a country, apparently, doesn't play by that rule. And until you understand why it doesn't, you have no idea when this system actuates. This isn't a trivia fact. This is the engine underneath your mortgage rate, your savings account, your job market, your retirement fund. Every time the Federal Reserve raises or cuts interest rates, it's wrestling with this debt. Every time you hear about a debt ceiling crisis in Congress, that's a symptom of this exact machine. And right now, in 2026, the pressure is higher than it's ever been. America's debt to GDP ratio, debt compared to the size of the entire economy, sits at roughly 123%. That means the country owes more than it produces in an entire year. Interest payments alone, just the cost of servicing this debt, not paying it off, now eat up about 14% of the entire federal budget. That's more than the US spends on national defense in many recent years. So here's the real question hiding underneath all of it. Is America actually broke? Or are we using a definition of broke that simply doesn't apply to a country with a printing press? Let's start with the basics, because this is where most explainers lose people. When the government runs a deficit, it means it spent more than it collected in taxes that year. To cover that gap, the Treasury sells bonds. A Treasury bond is basically an IOU. You hand the government money, and they promise to pay you back with interest. Sometimes in a year, sometimes in 30. So who actually buys these IOUs? Banks, pension funds, insurance companies, foreign governments. Japan and the UK are currently among the largest holders. And here's the part that changes everything. The Federal Reserve buys them too. When the Fed buys government bonds, it's effectively creating new money to do it. This is why people say America can just print its way out of debt. And technically, that's true. Unlike Greece during its 2010 debt crisis, which used the euro and had zero control over its own currency, America controls the dollar completely. It can print more, which means an actual default, where the US simply can't pay, is almost impossible unless it chooses to. But that raises the real question. If you can just print the money you owe, what does broke even mean anymore? This is where it gets uncomfortable. Printing money isn't free. The cost just doesn't show up where you'd expect. It shows up as inflation. When more dollars flow through the economy, without a matching increase in actual goods and services, each individual dollar becomes worth a little less. It's a tax nobody votes on. No bill gets passed for it, but it shows up on every grocery receipt. The inflation spike of 2021 through 2023 wasn't just a supply chain story. It was, in large part, the direct consequence of trillions of dollars printed during the pandemic finally working their way through the system. Now stack a second layer on top of that: interest rates. When the Fed raises rates to fight inflation, the government also has to pay more interest on its own new debt. That creates a loop. More debt, higher interest costs, more borrowing just to cover the interest, even more debt. The average interest rate the US now pays across its total marketable debt sits around 3.4%. 5 years ago, it was about 1.5%. That means the cost of carrying the exact same debt has more than doubled, without the government spending a single extra dollar on anything new. And here's the irony. Nobody puts on a headline. America is now borrowing money specifically to pay the interest on money it already borrowed. It's paying off one credit card with another credit card and calling it fiscal policy. The hyped version goes, don't worry, America can always print its way out. The reality is messier. Yes, the risk of an outright default is close to zero, as long as the debt stays denominated in dollars. But there's a different risk that doesn't get nearly enough attention: trust. The entire system runs on one assumption, that the rest of the world keeps believing in the dollar and keeps buying treasury bonds without hesitation. The moment that trust wavers even slightly, investors demand higher returns to keep lending. Interest rates climb, and the debt becomes even more expensive to carry. This isn't theoretical. Major credit rating agencies have already downgraded America's credit rating in recent years, something that had essentially never happened in modern history before this decade. And there's a second, quieter reality check. This entire system only works smoothly if the economy grows faster than the debt. But when interest payments alone consume this much of the federal budget, there's simply less room left for things like infrastructure, research, and education. At that point, technically not broke starts to feel like a hollow kind of victory. Because the real question was never whether America will default. It's how much is actually being sacrificed just to maintain the illusion that everything is fine. Zoom out far enough, and this stops being just an American story. The entire global financial system is built around the dollar. Oil pricing, international trade settlements, central bank reserves around the world. Almost all of it is denominated in dollars, which means when America prints money, it's not only Americans who absorb the cost. The entire world quietly shares that inflation tax. That's exactly why countries like China and Russia have spent years slowly diversifying their reserves, buying gold, exploring alternative currencies. It's not some grand conspiracy. It's a slow hedge against a system that everyone privately suspects can't expand forever. The long-term risk is simple to state and uncomfortable to sit with. If interest costs keep growing at this pace, within a few decades, America could be spending more on interest payments alone than it collects in total tax revenue. At that point, there are only three real options left: raise taxes, cut spending, or print even more. The third option is always the most politically convenient. It's also the one that keeps the entire inflation and trust erosion cycle spinning. So no, America isn't technically broke. The odds of an outright default are close to zero. The system is working right now, but working and sustainable have never meant the same thing. Every financial system in history that eventually collapsed said the exact same thing the day before it collapsed. It's still working. So the real question isn't whether America defaults tomorrow. The real question is, when the rest of the world finally decides that unlimited trust in the dollar is no longer safe, will we still be telling ourselves the system is working? Or will we have started asking, long before that day, how much longer it actually can? But America has a unique advantage. It can pay off debt denominated in its own currency, which it can also print. When countries around the world lend money to America by buying U.S. Treasury bonds, they're essentially lending America dollars. And if things get tight, the Federal Reserve can print more. No other country gets to do this. If Pakistan or Argentina tries to solve its debt by printing more of its own currency, that currency crashes and hyperinflation follows. America mostly dodges that outcome because global demand for dollars is so enormous that even extra dollars get absorbed by the system. That's exorbitant privilege. America runs a lifestyle funded partly by the rest of the world's savings, simply because everyone needs to hold dollars. Now, here's the uncomfortable part economists call Triffin's dilemma. Yale economist Robert Triffin predicted this problem back in 1960, and it comes down to a built-in contradiction. If the dollar is the world's reserve currency, the world needs an ever-growing supply of dollars to keep trading. And the only way America can supply the world with more dollars is by running trade deficits, importing more than it exports, sending dollars flowing outward. But if America keeps running deficits forever, its own debt keeps growing, and eventually, people start questioning the health of the U.S. economy itself. In other words, the dollar can only stay the reserve currency if America is willing to slowly weaken its own economic position to keep supplying the world with dollars. There's no clean fix for that. It's exactly why serious economists have been warning for decades that this system can't run forever, and yet, it's lasted more than 50 years. That's where the gap between hype and reality comes in. Hype versus reality. At least once a year, there's a headline: the dollar's collapse has begun. China is expanding yuan-based trade. Russia is doing dollar-free transactions. India and the UAE have signed rupee dirham trade deals. BRICS keeps floating the idea of a shared currency. All of that is true, but the data tells a different story. Global foreign exchange reserves are still roughly 58% dollars. That share has been declining. It was over 70% back in 2000. But the currency replacing it isn't the euro or the yuan. It's diversification. Australian dollars, Canadian dollars, smaller currencies picking up small slices. The yuan's share of global reserves is still stuck around 3%. Why? Because China maintains capital controls. If you hold yuan, you can't move it freely, convert it easily, or withdraw it the way you can with dollars. Becoming a reserve currency takes more than economic size. It takes trust, transparency, legal predictability, and liquidity. And no other country has matched that combination yet. Here's the irony. The system generating the most frustration is still, for now, the safest option available. Every alternative, the yuan, the euro, gold, crypto, comes with its own baggage. But that doesn't mean there are no cracks. The 2022 Russia sanctions were the first time central banks around the world got a very practical demonstration that holding reserves isn't a risk-free position. It can also become a political weapon. That's exactly why, since 2022, central banks, especially China, India, and Turkey, have been buying gold at record levels. Gold is an asset no country can freeze because it can be physically stored in your own vaults. This trend looks small, but the signal is big. Countries around the world are quietly building an insurance policy in case the dollar system is ever used against them. So the reality is this: the dollar is still dominant today, but its dominance is no longer assumed, it's actively being questioned. And that shift from assumed dominance to active scrutiny is the real story here. Zooming out, the bigger implications. Now let's zoom out to the bigger picture. If the dollar's position weakens, gradually or suddenly, the effects won't stay confined to America. First, borrowing gets more expensive for the US government. America can borrow cheaply right now because the rest of the world treats treasury bonds as the safest asset on earth. If that trust erodes, interest rates climb, and America's own $34 trillion debt gets more expensive to service, which flows straight into taxes, government spending, and the broader economy. Second, sanctions lose their teeth. Right now, America can isolate any country globally through the dollar system, as it's done with Iran, Russia, and North Korea. If countries build payment systems outside the dollar, that geopolitical weapon gets weaker. Third, and more subtle, global trade gets more fragmented. Using one dominant currency keeps things simple. Everyone has the same reference point. If the world splits across multiple currencies, dollar, yuan, euro, gold-backed systems, transaction costs rise, and trade gets slower and more complicated. But here's something worth being clear about. This isn't an overnight collapse story. Currency dominance shifts over decades, not weeks. The British pound was the world's reserve currency through the 19th century. Its decline started in the 1920s, and the full transition from pound to dollar took roughly 25 to 30 years after that. So if the dollar ever loses its position, that process won't be fast either. It'll be gradual, much like what's happening right now. The real question isn't, will the dollar collapse? The real question is, as long as the dollar stays dominant, will the rest of the world stay comfortable with that arrangement? Or will a little more distrust get built into the system every year? Because trust is the actual foundation this entire system rests on. Not gold, not oil, not military power, just trust. Closing, the question that's left unanswered. So let's go back to where we started. Sri Lanka buys oil from Russia in dollars, a currency with no direct connection to either country in that transaction. This system has run for 80 years, sometimes on trust, sometimes on necessity, sometimes simply because there was no better alternative on the table.